Everyone. Before we start the core analysis part of the video, I have a quick question for you. When you select any mutual fund, what type of returns do you look at? You can take a second or two, and if you want to share, you can type your answer in the comment section of this video. But my guess is most of us generally look at the point-to-point return, or in other words, CAGR, compounded annual growth rate of the mutual fund. So what we do is we look at a 3-year CAGR, 5-year CAGR. We compare it with category average, or we compare it with the benchmark, and we check that okay, fund is outperforming the benchmark, so it's a good fund, and then we decide to invest. But actually, it's a wrong thing to do. Now, that's not my words. This is what Radhika Gupta ji of Edelweiss Mutual Fund is telling. So she is MD and CEO of Edelweiss MF, and according to her, most of the MF platforms show point to point or discrete returns, right? And this is a broken metric because one good or bad year can have a huge impact. But the actual thing is the right thing to do is to look at rolling returns. Now, if you don't know what rolling returns are, then let me give you a quick explanation. So, as you can see, what rolling returns does is rather than taking just one starting point and one ending point, let's say from 1st Jan 2022 to 1st Jan 2025, what we can do is we can take 1 year period, different periods, and then take the average of it. Right. So from 1st Jan 2022 to 31st December 2022, this is one period. In that period, 4.27% is the return. Now from 2nd Jan 22 to 1st Jan 2023, another period, 2.41% return. And then we keep taking one year period each day. So it's basically like doing a daily SIP in any mutual fund, and then averaging out the return. So you take various periods and then you average out the return. So the actual rolling return, 1 year rolling return number for this hypothetical fund is 5.31%. So you may see that on any particular instance in this 1 year period, the fund return is 13.6%, 10.64%. But when you average it out for the volatility, the rolling return comes to 5.31%, which is not good. Right. So actually, you should be looking at the rolling returns of the funds. And that's why on Sharply, we have introduced rolling returns in for all the mutual funds. So as you can see, if I open any mutual fund, so we will take the example of Parikh Flexi fund, the mostly discussed or widely discussed fund available in the market. So we will take the example of Parag fund, and when you go to the performance section, we have revamped this rolling return section of the mutual fund analysis. And as you can see, yeah, we are taking 1 year time frame. So the first data point that we get is from 5th June 20, 5th May 20, sorry, 5th June 2013 to 4th June 2014. So that's the first year period, and then we take one year period each day, and then average return comes out to, so for 1 year period, average return comes out to 22.08%. This is the standard deviation, which is a measure of volatility. If you are into statistics, you should be familiar with this number. And then here we have different type of data points to analyze. So best return period is, in 1 year, this fund has generated 95.66%. So almost not doubled your money in a year. The period is the year ending on 26th March 2021. So if you would have invested on 25th March 2020, that is the COVID crash, in 1 year, your money could have been doubled. The worst period is minus 21%. Again, the year ending in 2020. So, this is the key analysis of rolling returns, because here you can see that on a worst year, the returns can be minus 21%. The best year is 95.66%. Now, all the periods that we have taken till now. So there are thousands of data points, right? Because from 2014 to 2025, there are thousands of data points. Uh, Positive returns have been generated by 92% of those data points. So 92% of the times, if you are investing in this fund, you will be getting a positive 1 year return. Right, 81% of the times you will be getting a return of more than 5%. 70% of the time you will be getting return more than 10%. Right, and 60%, 61% of the time you will be getting 1 year return greater than 15%. And as you can see, beat percentage category. So now we compare this with category average. So 70% of the time, if you take 1 year time frame, the fund is beating the category, right? And 76% of the time it is beating Nifty 500. Now you may say that, okay, 70% is not a good number, but that's for 1 year. In mutual funds, you will be investing in a longer time frame, right? So if you take the example of 5 year period, so now what will happen is the first data point will be that we will invest our money on 26th June 2013 to 27th June 2018. So this is the first data point that ends on 2018 to the last data point that's end on 7th November. Right. So now if you look at the numbers, the average CAGR is 19.72%, which is a very good number. Right. And period with positive returns is now 100%. So if you take 5 year period, 100% of the data points are giving positive returns, not a single data point that gave negative numbers. Right? So this is a remarkable consistency when it comes to mutual fund performance. Now, period with 10%, more than 10% return, 96% of the times in 5 year time frame, you will be generating more than 10% CAGR. 82% of the time you will be generating CAGR more than 50%, 15%. So again, if 4 out of 5 days you are getting CAGR more than 15%, again a remarkable thing. Right now, if you look at these numbers, 99% of the time the fund is beating the category average in 5 years. And 99.72%, so almost 100% of the time it's beating the benchmark. So this is the metric that you should look at. Right, the rolling returns is the metric that you should be focusing on. While it's important to look at this trailing returns as well. That in last 6 months the scheme has generated this, the category has generated 7.83, the benchmark is 7.88. Right, it's also important to look at period returns, but both these data points do not consider the risk involved in between those points. So one fund can be very volatile, so starting point can be 100 and ending point can be 150, but there can be very high volatility. And in another fund, same starting and ending point can be same, but there can be a smoothness. And the rolling returns give you that analysis. So now, before you select any fund to invest in, come to Sharply, search for that fund and analyze this rolling return for various time frame based on your investing time frame. So if you are planning to invest for more than 10 years, then best thing to do is to look at 7 year period. And as you can see, 100% of the time you are getting more than 15% CAGR. So you can confidently say that you might be generating more than 15% CAGR if you invest in this fund and the fund continues to perform in a similar manner. So again, not a buy and sell recommendation, but just a very important data point that you should look at before investing in any mutual fund. Now, if you like this video, you can hit the like button and share with your friends who are investing in mutual funds and leave a comment. Thanks.